is the August 2023 question 5. August 2023 question number 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 5. Now, group cash flow statements are captured under what we call International Accounting Standard number 7 that recommends that we should be able to do a cash flow statement as one of those annual reports. Annual reports, the annual reports, how you report annually for your company. You must have like an income statement, a statement of financial position. Then we have in this case here, cash flow statements, statement of equity, and what here, changes in equity. So group cash flow statements will be required. And you can prepare this group cash flow statement using what we call direct method. Direct method. That's number 1. And then number 2, we have the indirect method. In the indirect method. So IS7 in this case here recommends the second one. This second one is the most popular and is the easier. Of course, both of them are not hard, but indirect method is very, very easy. So today I'm going to teach you how to prepare a cash flow statement using indirect method. So we will basically have 3 sections. 3 sections. Regardless of the method you're going to use, we shall always have 3 sections of this cash flow statement. Cash flow statement, you shall always have what here? 3 sections. Which sections are these? Number 1, we have in this case here what we call cash flow from operating activities. Cash flow from operating activities. That's number 1. Regardless of whether you're doing this cash flow using direct or indirect method, we shall have cash flow from operating activities. Then number 2, we shall have cash flow from investing activities. Cash flow from investing activities. Cash flow from investing activities, very, very important, very, very important. All right. And then number 3, lastly, we have here cash flow from financing activities. Cash flow from financing activities like that. Very, very important. So basically, when we talk of operating activities, we are looking at revenue. We are looking at revenue, cost of sales, and operating expenses. Cost of sales and operating expenses and operating expenses. Those 3. Yeah, our revenue, our cost of sales every day. When we sell things, you're going to be declaring this cost of sales. And you're going to have in this case here operating expenses. Operating expenses. Right? When we talk about investing, we must be thinking about long term. All right? We must be thinking about long term. And long term, of course, we are investing in PPE. So here we are looking at the non-current assets. Non-current assets. Non-current assets. Non-current assets. We invest in our non-current assets. On a non-current assets, what are we looking at? We are looking at, for example, buying of property, plant, and equipment items. All right. We're going to be buying shares. We're going to be buying associates. We're going to be buying subsidiaries. And the investing activities also, we have the opposite of investing, remember, right? What we call divesting. When you sell PPE, then you recognize that under here. So remember, under non-current assets, you're looking at purchasing and what here? Selling of those items. You've disposed a subsidiary, you'll be able to bring it under here. And then when you talk about financing activities, we are looking at how do we acquire this capital, right? So in this case, how do we acquire funds for running our company here? So we are looking at equity, and what here? Debt. Equity and debt. At times we have preference shares, but preference shares are not very, very common. So basically, we're looking at equity and debt. Equity and debt. So you shall be able to issue shares in the year. we shall be able to pay these people here their dividends. All right, that will come here. All right, we shall be able to issue or redeem debt instruments, etc. etc. So have you guys been able to write up to here? Have you guys been able to write up to here by any chance? Have you been able to write up to here? All right, thank you very much. So then we start straight away tackling this question, and we are tackling it using the indirect method. We are tackling it using indirect method. So what is the name of the company? You must always write the name of the company, the name of the group. It is Ukulima. Ukulima. So we have here Ukulima Group. So under Ukulima Group, what are we doing for Ukulima Group? We are giving them group cash flow statement for the period ending, of course, that one I know you guys are able to get this very fast written down. 30th September 2022. So you're using the indirect method. We're using the indirect, you can write a dash there, indirect method. So group cash flow statement for the period ending 30 September 2022. So then how do we start this? We start with the first section, which is cash flow from operating activities. So cash flow from operating activities. So cash flow from operating activities. Cash flow from operating activities. All right. And then, of course, if it's indirect method, this is what we are doing. You start always with the profit before tax. Always. You should always start with the profit before tax. Is there somebody who is able to see the profit before tax in the income statement? Remember, for you to do this, you must be given statement of financial positions for 2 years, and then income statement 1 year. You can see in this case here, we are given a consolidated statement of financial position for the year ending 22, and for the year ending 21, and for the year ending 21, and for the year ending 21. And then you can see there vividly that they're giving us consolidated statement of P&L and other OCI and other comprehensive incomes, just one, like that. So in this income statement, is there somebody who is able to tell me what is the profit before tax? What is the profit before tax? Somebody who is able to give me the profit before tax. Somebody who is able to give me the profit before tax. Just go there very fast. Give me the profit before taxation. 88. So our figures are in millions, remember. Our figures are in millions, remember. So in this case here, profit before tax, we have 88. Profit before tax, we have 88. That's very, very important. Profit before tax, we have 88. After that, ladies and gentlemen, we shall be able to remember our acronym. There's an acronym you'll always use and I direct. There's an acronym. You'll come and say here, adjusted for. Please never forget this acronym. Adjusted for, you say, dial God's number for food. Or you rest in peace, Now I'm going to introduce two new. This time around, I'm introducing two new. Or you rest in peace totally, indefinitely. So you dial God's number for food. Don't bring any here. Dial God's number for food. All right, for food. Or you rest in peace totally, indefinitely. Totally, indefinitely. These are very, very important acronyms that we have used for years. Whenever you're looking at indirect method, you remember this. Direct method, you can't, in this case, you use this acronym. You can't use this acronym. All right. So the first D stands for what here? Depreciation. depreciation. Here we have impairment loss of goodwill. Impairment loss of goodwill. It's only for goodwill. Impairment loss of goodwill. We have amortization here. Here we have amortization. Here we have loss on disposal. Anything you dispose, it could be a PPE item. It could be a subsidiary you have disposed and you made a loss. So loss on disposal. Loss on disposal. Just allow me to write this. Let me just write this. Let me write this. So we have here our profit before tax of 88 million. And then we are saying adjusted for what here? Adjusted for. We have here dial, God's number for food, or you rest in peace totally, indefinitely, like that. Look a bit bigger. So this one here is depreciation, impairment, loss. But just say impairment of goodwill, no problem. Impairment of goodwill. Then we have amortization. So we have here amortization. We have here loss on disposal. We have gain on disposal. So we have here finance cost. We have here working capital changes. You underline this. Then we have receivables. Then we have inventory. Then we have payables. Then we have here tax paid. And then we have interest paid. So remember, interest paid is normally arguable. You could either put it under operations, or you take it under the financing activities. Interest paid is arguable. Yeah. So you can decide either to put it here or you put it under financing activities. You can never be wrong. Why do we have some scholars saying we put it under our working capital, or rather not working capital, but under our operating activities? It's simply because, ladies and gentlemen, you can't operate without loans, really. Without loans outside there, you can't operate. If you're running a very, very big company, like, for example, RCM, which is thinking about, in this case here, having a primary school somewhere, you can't operate without loans. So we need, in this case here, loans. That is why we shall be putting this under operating activities. Without loans, you can't operate. All right. So have you guys been able to write up to here, really? Have you guys been able to write up to here? There are very, very many activities, very, very many items here. So at times my handwriting may not be legible enough, but by luck, have you been able to write? All right. Thank you so much. So we start by pulling the profit before tax. Very easy. So profit before tax, that we have been able to pull. Then look at your notes here. I mean, you are picking these things very fast. Look at note number 1. So you go to the notes here. So note number 1, machinery with a carrying amount of 12 was disposed of for cash for 10 million. So ladies and gentlemen, we had machinery that was worth 12 bob. The worth here is 12 bob, but we are selling them for 10. So remember, how do we get profit here? To get profit, you simply look at the revenue you have gotten. The revenue you have gotten minus the cost. So our profit in this case here will be the revenue that we got, minus, in this case here, the carrying, what they can call the net book value. The net book value is our cost, which has been depreciated. So these machines, we did sell them for 10. Remember, our figures are in millions. When they were worth 12. when they were worth 12. So this gives me a profit of -2, which basically is a loss of 2. A loss of 2. A loss of 2. So when this accountant, in this case, he realized that he has gotten a profit of -2, he must have adjusted here. He must have reduced his profit there. But we're saying in terms of cash flow, this is not a cash flow. So come and do what you add back. So loss, so we have here loss on disposal, it will be 2 like that. So loss on disposal is 2. We had machines worth 12 bob, but we sold them for 10. So the loss on disposal there is 2. The loss on disposal there is 2. And it shall be positive. What you shall realize in this statement, all costs and losses shall be added back. All costs and losses here shall be added back. But anytime you have a gain, you know, a gain, when you're adjusting a gain must have been added here. So how do I adjust? Subtract. So all losses and costs will be taken here as positive, will be taken as positive. So that is the first thing. In this case here, you have 1 or even 2 marks. Remember how they mark? We are very, very, in this case here, generous in marking. So from there, ladies and gentlemen, you will be able to continue reading there. Depreciation of 52 had been charged to operating expense. You can see we have depreciation here. 3 marks really. I love cash flows. 52. Depreciation of 52. Right? Now from there, ladies and gentlemen, what else are they telling us? They're telling us as a result of a revaluation of 𝐂𝐸𝐸 Group factories during the year, a transfer was made within equity for excess. That does not affect me. Including trade and other payables at the reporting is 2 million. So including trade payables, that does not affect me at all as of now yet. So note number 1, done. We go to note number 2. 𝐂𝐸𝐸 Group received a government grant of 3 million in cash during the reporting period to help fund acquisition of machinery needed for its production process. So these I'll be able to, of course, you can see we are acquiring machinery, which are non-current what year assets. So of course that will go under investing. That cannot come under operations. You're not in the business of buying machines every day. No. These are no investing activity. So note number 2, for now, we shall not use it. But of course, if I were you, I would straight away have, for example, like if I know how to do these things very well, like investing activities, financing activities, big spaces, then I can be filling in myself here. I'm limited. I can't do that because of the size of my board. So I shall go just step by step. Otherwise, if you have investment activity somewhere there, then would have booked that 3 million, which was given to you for acquiring assets there. Go to note number 4. Note number 4. We are told 𝐂𝐸𝐸 Group disposed of some of its shares held in Shamba Limited. 𝐂𝐸𝐸 held 90% of the shares in Shamba Limited before disposal and 40% of the shares after disposal, leaving it with significant influence. The 𝐂𝐸𝐸 Group received cash proceeds from the sale. That's under investing because, of course, we sold a subsidiary, a long-term asset. The profit on disposal is 3 million, was correctly calculated and credited to the statement of profit. So I can see profit on disposal, which is the same as gain. So this is profit here. Profit on disposing a sub of how much? A sub of how much? Of 3 million. A sum of 3 million. So gain on disposal. Gain is the same as profit. But now remember, this profit was added here, and you're doing adjustments here. So profits here shall always be captured in brackets. 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 All right. Then we are told, ladies and gentlemen, there, note number 5. Note number 5. During the period, shilling 65 million in cash was spent on investments that will go some other place. Not there, not here. 6 finance costs included a shillings 2 million loss on the translation of a loan that was denominated in foreign currency. That we shall be able to see. Ladies and gentlemen, once you reach now here, now you've been able to do very many things from your notes. Notes the accounts. Now, once you reach here, you go straight away to your income statement where you are able to see profit before tax. You are able to see profit before tax here. You are able to see profit before tax. Profit before tax is 88. Now you look north, you look up. For any non-operational item, we look up for any non-operational item. So non-operational items, so now we are looking up, Like for example, I can see there, the first one there, you see profit before tax. Profit before tax, we have 88 there, right? So I'm looking up. I can even start from revenue. So revenue is operational. That is okay. We have cost of sales that is operational. That is okay. We have gross profit, of course, that is it. Operating expenses, that is okay. Profit from operation, that's okay. Then see there, share of profit in associate. Share of profit in associate, that is non-operational. When we started, I gave you 3 operational things. Are you able to remember those operational items that I gave you? There are only 3 operational items. What and what and what and what? There are only 3 operational items. We have revenue, we have cost of sales, and then we have operating what year expenses. There are only 3. Revenue, cost of sales, and operating expenses. Any other thing there is never operational. Like now we have share of profit of associate. That is not operational. That shall be removed from here and taken elsewhere. Taken to investing activities. We have invested in an associate. All right. So in this case here, we need to come and remove this. So you will need some space. I don't know whether you guys have some, you can squeeze it somewhere, anywhere. Just squeeze it. Squeeze it. So squeeze it. Now, ladies and gentlemen, then as I squeeze this, I can come and like now mine here, I can come and talk about what here? Profit from associate. So profit from associate. So profit from associate, how much are they giving us here? Profit from associate, how much are they giving us there? 21. So this profit from associate that I have here as 21, as 21, as 21, I will have to deduct it. I'm deducting it. Yeah, remember they had already added it up there, and I'm supposed to do what here? I'm supposed to deduct it. So I don't know whether up to here, ladies and gentlemen, we are okay. Have you guys been able to remove it? Have you guys been able to remove it? Ah, great. Just squeeze it somewhere there. Remember, you're looking northwards. So northwards, what we are doing there, we've been able to see share of profit in associate. We have removed that one. Profit on disposal of shares in a subsidiary. Profit on disposal of shares in a subsidiary 3. That is non-operational. I'm supposed to remove it. But fortunately, from the notes, I was given that 3. Do you remember that 3? Do you remember that 3 already? We have removed it here, profit on disposing a subsidiary. These ninjas are not remembering this thing. That 3, we got that 3 somewhere. We got that 3 somewhere. Don't double count. We got that 3 somewhere. We got that 3 somewhere. Now, from there, ladies and gentlemen, we have finance cost. So finance cost, of course, is operational, but first of all, I will remove it. First of all, I will remove it. Yeah, not 2. First of all, I will remove it here. So finance cost, I can see the way it is. Finance cost, the way it is. Finance cost, I can see it is 12. It's a cost. So if it's a cost, I'm adding it. You put it there, but I'll be able to do the adjustment down here. So finance cost, you put it the way it is there. From there, we shall be able to go to impairment of goodwill. Impairment of goodwill, you track. Impairment of goodwill, you track the goodwill account. So impairment of goodwill, let's track the goodwill account. Let's track the goodwill account. Let's track the goodwill account. So if you wish, you can do the T accounts, but of course, as you get used to this, you shall avoid T accounts. So goodwill account. So remember, goodwill is under non-current assets. So under non-current assets, is there somebody who is able to see goodwill? Under non-current assets, is there somebody who is able to see goodwill? Remember, 2021 is the initial year given. So 2021 shall be our balance brought down. So goodwill balance brought down. Balance brought down. How much do we have there for goodwill? How much do we have there for goodwill? Balance brought down. I'm being given 103. So I'm being given 103 here. This is balance brought down. How about balance carried down? How about balance carried down? How about balance carried down for 2022 now? So 103 versus what year? Versus 20 versus 204 versus 204. Ladies and gentlemen, then we ask ourselves, what will bring changes? What will bring changes? What will bring, oh, it is 142. They're saying, Mwalimu, this is 142. They're saying, Mwalimu, this is 142. Balance breakdown is 142. Ninja, 142. So balance breakdown here is 142. How about in this case here, balance carried down? Balance carried down, 75, eh? So I'm being told balance carried down is 75. Balance carried down is, so what can bring changes to my goodwill account? Only two things. If we acquire a new subsidiary, then goodwill will go up. If we sell, in this case here, a subsidiary, goodwill will reduce. In this particular question, we sold a subsidiary. The subsidiary that we sold went away with how much in form of goodwill? Is there somebody who is able to see the goodwill that was disposed? Look at note number. Look at note number. There's a note number talking about us disposing a subsidiary. Note number 4. Ukulima Group disposed of some of its shares held in Shamba Limited. Ukulima Limited held 90% of the shares in Shamba Limited before disposing and 40% of the shares after disposal. So remember initially, we had 90%. Now we are left with only 40%. So we sold what percentage? 50%. Remember, initially we had 90%, which was a subsidiary. But now we only have 40%. So when you have 40%, what does that mean? That now we have an associate. So we have disposed basically a subsidiary. We have made, in this case, our investment, which initially was a subsidiary, to become an associate. So then once it becomes an associate, it must go with some goodwill. We must, in this case, sell the goodwill. So in this case here, we have goodwill sold. Let's see there. We are told the last statement. Goodwill, an uncontrolling interest at the disposal date was 40. I'm concerned with goodwill disposed. So we have here goodwill disposed. Goodwill disposed, 40. So then in the absence, so come and do the balancing. Please do the balancing for me. I'm able to see this is 142 is bigger. 142 is bigger. So 142 minus 75 minus that 40 disposed. So of course, the balancing figure here will be goodwill impaired. It's goodwill impaired, a loss there. So is there somebody who can give me this loss or goodwill impaired? They're saying it's 27. So in this case here, impairment loss is 27, like that. So impairment loss, impairment of goodwill is 27. Shall it be positive here or negative? Shall we have it as positive or negative? Shall we have it as positive or negative in our statements? Shall we have it as positive or negative? Positive, yes, because it's a cost, it's a loss. Remember, all losses and costs here will be what here? Positive. It's only gains. Like now, this is a gain on disposal, which is negative. Also, this one here was a profit from associate, negative. But every other thing in this case here remains what here? Positive. Costs and losses shall always be taken as what here? As positives like that. As positives like that. Now, there is one thing here that is really, really hidden. One thing that is really, really hidden that most guys, of course, will not be able to see. There is one thing that is really, really hidden here. Look at your investment property. Investment properties. Investment properties. Are you able to see investment properties, ladies and gentlemen? Are you able to see investment property, ladies and gentlemen? Investment property. Investment property. Quite hidden. Most students will not be able to get this in an exam. Quite hidden. Quite hidden. But of course, when you are doing your investments, you'll be able to see it. You'll get it even when you are doing your investment. So investment in property. So investment in property, this is an asset. Please bring down. So balance brought down is how much? Investment in property, balance brought down is how much? Balance brought down. Oh, please talk to me. Balance brought down is how much investment in property from your current non-current assets. Remember, brought down is 2021. Brought down is 2021. So investment properties brought down, here we have 60. How about balance carried down? How about balance carried down? Balance carried down is how much here somebody investment properties. Balance carried down, thanks Laura. Balance carried down is how much? It's 82. Is there any properties we bought? Any investment in property that we acquired? Yeah, if you look at some note there, note number 3, note number 3, note number 3, note number 3, you can write down note number 3. Ukulima Group accounted for investment properties at fair value. Some new investment properties were acquired at a cash of 14. So in this case here we have, of course, this is increasing. So new investment property, 14. So then what else in this case here may have made this investment in property? I mean, you see this is 74 and this is 82. So what we have, ladies and gentlemen, here, what we have here, this will be 82, this will be 82. The moment they have told me that their investment properties in properties are fair valued, then I know there must have been some revaluation. So we have here a revaluation gain, a revaluation gain. It's a gain because it's on this debit side. So 82 minus 14 minus 60 will give me how much, ladies and gentlemen? Will give me 8. So again, squeeze. Today is about squeezing. Squeeze this thing somewhere. Squeeze it. It is the last one. Squeeze it. I can come and squeeze mine here. I can even squeeze mine here. So we have here evaluation what here? Squeeze it anywhere. You must leave some spaces. Evaluation gain. So it is 8. So it shall be captured as a negative figure. It's a gain. Evaluation gain on investment property, on IP, investment property. 8, like that. Of course, initially, that's why I want you to be living. Even when we continue, you'll be surprised. There is a very high possibility that we may get other new things. We may get other new things. We may get other new things. All right. Then, ladies and gentlemen, please come here. Under working capital changes, now we have, of course, working capital, we have these 3. Receivables, inventories, and payables. But before I continue with this, are we together somehow? Are we together somehow? Are we together somehow? All right. Thank you very much. So then let's get, in this case, I love these working capital changes. These are normally low-hanging marks. These are normally low-hanging marks. These are normally low-hanging marks. So under working capital changes, we normally use the acronym OC. It is opening minus inventory. It is opening, not inventory, but opening minus closing. Opening minus closing. Anytime you have working capital changes, mambo mengi, opening minus closing, minus, I will be able to talk about what here, minus subsidiary disposed. Yeah. If we acquired a new subsidiary, we would have said plus a subsidiary acquired. But this is a subsidiary that was disposed, so it must be leaving out with some things. Yeah, so we start in this case here with the first one here, which is receivables. So receivables, are you able to see the opening receivables for 2021? Are you able to see the opening receivables for 2021? You guys must talk to me this morning. This is an exam area. Those ninjas who normally call me wakiniambia mwalimu tupatie leakage. So see leakage napata lakini for free. This is an examinable area, I can assure you. There are 2 things that you must always know. Group consolidation, group cash flow, and you have your 30%. And once you get 30%, you have passed your exams. Is the pass mark that low? No. It's because if you get 30% from your computational questions, the other qualitative, the theory areas, you'll be able to get quite a lot. So the moment in this case, the students will tell you that mwalimu hii ndio tunaanguka nayo. Hii ni very, very important. Group cash flow, group consolidation. And I love even group cash flows more because unlike group consolidation, which can be a bit tricky, this one here will never be tricky. This one is direct, straightforward. So receivables, so opening receivables in the balance sheet, opening receivables, you go to your current, remember working capital is under current assets. So receivables, I can see yes, 263 minus 219. 263 minus 219. Now, this note number 4, we disposed a subsidiary. The subsidiary that we disposed, did it have any receivables? Does it have any receivables? This is note number 4. Are you able to see a breakdown of Shamba Limited's net assets? Yeah, it has 32 years. You can see it has traded other receivables 32. It has. So this has to go away like that. So then what do we have here for receivables? What do we have here for receivables then? What do we have here for receivables? What do we have here for receivables? So receivables in this case here is 12. I'm being told it's 12. 12 positive, right? 12 positive. Positive. You take it with a sign. Yeah. Please go and do the same for Mwalimu here. I would want to see whether there is anybody who will be able to do the same for inventory for us. Do the same for inventory for us. Go ahead and do the same for inventory for us. Go ahead and do inventory for us. Inventory. It's about opening minus closing minus the subsidiary disposed. So in inventory opening, is there somebody under current assets? Is there somebody who is able to see inventory under current assets? How much do we have there? Yeah, 201, 256. Minus the disposed subsidiary, it doesn't have any inventory. No inventory there, 0. So then this will give me what figure? This will give me what figure? This will give me what figure? Minus 55. Minus 55. You bring it with a sign without reasoning. Now for payables, not many will get payables easily. So for payables, you must be quite knowledgeable. So for payables, we have opening. Are you able to see the opening? So for payables, are you able to see the opening payables under current liabilities? Yeah, 486. 486. So we have here 486 minus 522 minus 522 minus 522 minus this subsidiary that left us went with the payables worth 55. It went to the payables worth 55. And they're saying it's 524. Yeah, because there is a note that I have here in my mind, because I've done this question severally. There's a very important note that I have here in my mind, which I'll never forget. Yeah, note number 1. Note number 1. We are told the machinery with a carrying amount of 12 million was disposed of for cash proceeds of 10 million. Depreciation of 52 had been charged to operating expenses in the statement of P&L as a result of a revaluation of 𝐂𝐸𝐴 Group factories during the year. A transfer was made within equity for excess depreciation of 1 million. Included in trade and other payables at the reporting date. At this time when your payables are 524, included in trade and other payables at the reporting date is links 2 million that relates to property, plant, and equipment purchased during the period. That they purchased in this case here PPE worth 2 million. Huyo accountant mzembe akapeleka hiyo figure kwa payables. So payables in this case here at 524. Payables at 524 has an error of 2. So the adjusted payables will be 524 minus 2. So that 2 we shall be taking it to PPE. The 2 we shall be taking it to PPE. So are we in agreement that the closing payables are supposed to be 522? Yeah. Great. Kwa hivyo inamaanisha namna gani? Inafaa kuwa ngapi oye? Payables inafaa kuwa ngapi? Payables inafaa kuwa 91, 522. 522. This 522. So payables is at 524. As we say here, I mean, it's 524. But there is an error of 2 there is an error of 2 because of misclassification. Because of misclassification, there is an error of 2. And therefore, the adjusted payables will be 524 minus what here? Minus 2. So then 486 minus 522 minus 55, that will end up giving me what figure? Vincent, I hope you're able to see that. Yeah, so in this case, ladies and gentlemen, we are supposed to be having payables of minus 91. Payables of minus 91. Is there somebody who is getting minus 91? Is there somebody who is getting minus 91? Okay, I've seen minus 91. Is there anybody who is getting positive 91? Is there anybody who is getting positive 91? Positive 91. You got a calculator zao zinakataa kazi. Please be honest with me. Is there somebody who is getting positive? Thank you so much. A payable is a liability. Whatever you get here for liabilities, you must always multiply them with -1. Not with assets, not with any asset, but any liability, payables. If I were you, I would have written that in my mother tongue, that payables, whatever figure of, because I mean, we don't have any other liability here. Whatever any figure of payables I get, I have to multiply the net value with -1. I must change the sign. I must change the sign. I must change the sign there. So then are you able to see where they're getting minus 91 from? Are you able to see where they're getting minus 91 from? Are you able to see where they're getting minus 91 from? Not positive 91. Hiyo 55 or 55. 55 wewe Vincent. Si ni ile kitu ya nini? Subsidiary disposed. The subsidiary disposed. Subsidiary. Remember, we take opening minus closing minus subsidiary. Minus subsidiary. The subsidiary disposed, it had in this case here what here? It had a payable of 55. Vincent, maybe ulichelewa kidogo kuingia. Ukiangalia kwa hiyo note number 4, sijui kama umeiona. Una ka trade under other payables 55. Resa anasema it's 91. So should I write positive 91 ama negative 91? Abracadabra. Oh, the answer before multiplying was negative 91. So then after multiplying, so after multiplying, it should be 91. Oh, I thought these ninjas were giving me the correct answer. Or they were giving me that just that minus 91, which I ought to have multiplied with this -1. This -1. So then are we in agreement, all of us, that it's supposed to be positive here? Are we in agreement? It's supposed to be 91 positive. Great. Thank you so much. Now, niko kwa mkondo wa mwisho. I love this. We go to the taxation paid. We go to the taxation paid. Taxation paid, I know you guys love T accounts. They are good. They are good because of the pictures. But of course, as you really get used to this, so come and give me tax payable account. So tax payable account, this is a liability. So give me balance brought down here. Current tax, deferred tax. Balance brought down. Balance carried down. Balance carried down. Balance carried down. Balance carried down. So current tax, deferred tax. CT stands for current tax, deferred tax. Very easy. Very, very easy. Remember, tax payable is a liability account, so we bring down on the credit side. We bring down on the credit side. On the credit side. So balance brought down. Current tax, please go to your balance sheet. Are you able to see the current tax, you ninjas? Under liabilities, yes, I can see income tax payable. So I'm seeing a 12 and 23. Is there somebody who is seeing current tax? 12 and 23. Brought down is 12, carried down, in this case, is 23. I think I'm alone, but I will overcome. I think I'm alone, but I will overcome. All right. Thank you so much. Now, ladies and gentlemen, after that, we look for deferred tax. Under non-current liabilities, I'm able to see the deferred tax. So deferred tax is 33. Brought down here is 33. Carried down here is 33. No. It can't be the same. 33 and 44. 44. And then now we look at the P&L. So the P&L, CT, DT, P&L. P&L is for the year. P&L, profit and loss for the year. We are crediting because P&L will increase. So in this case here, the P&L, ladies and gentlemen, I can see the P&L. Is there somebody who is able to see P&L where we have income tax expense? Oh yeah, income tax expense ningapi. P&L income tax expense ningapi. P&L ya pili 19. So P&L CT, this current, it's in the profit and loss. Of course, this DT, deferred tax, will be under OCI, other comprehensive incomes. Other comprehensive incomes. Any tax which is under other comprehensive incomes will be called a deferred tax or tax on revaluation. OCI is other comprehensive incomes. Other comprehensive incomes. So is there somebody who is able to see under other comprehensive incomes, we have gain on revaluation of PPE, and then we have income tax on those. So that income tax, which is under OCI, it must be deferred tax, and I can see 10 there. So please come and balance this. I can see this is 67. So this side will be higher. This side will be higher. This side will be higher. So please, CT stands for current tax. OCI is other comprehensive incomes. Any tax you find there, it will be called a deferred tax. It will be called deferred tax. It will be called deferred tax. So is there somebody who is able to give me this total? It's very fast. And today I'm supposed to have a very early morning meeting at the office. So these guys are telling me that Mwalimu, we have already done, in this case here, we are getting balancing figure as tax paid bank 7. So please kaza mkono kidogo 7. But just for my students in future, we'll be looking at this video. Could you kindly give me this total? Are you able to give me this total here, ladies and gentlemen? So some students in the future will be looking at this video, maybe not as bright as you guys are. Yeah, please give me a total there to help them. 74. So we have here 74. So we have here 74, and that is 7. So in this case here, tax paid is 7, like that. And then now we have interest paid. Fortunately, we don't have interest payable. Oh, this other side. Sorry. Yeah, by the way, you see now, it's good I did this. Thank you very much. The lower, this balancing figure comes here, 7. Tax paid, yeah. So we debit this, we credit the bank account as tax paid. Thank you very much. So for interest paid, we don't have, in this case here, interest payable account in our current liabilities. So in this case here, interest paid, it will be the 12. But remember, there is also a misclassification of 2. There is a misclassification of 2. Remember, interest paid is the finance cost. And if you look at note number 6, finance cost included a 2 million loss on the retranslation of a loan that was denominated in foreign currency. So that is a loss on retranslation, the 2. So the actual interest that was paid is supposed to be 12 minus that 2, which gives me 10, like that. It gives me 10. So and that is it. So go ahead and give me, the cash flow from operating activities. So remember this 10, you can still take it under financing activities, but this semester, we shall do it this way. Cash flow from operating activities. How much do we have from the very beginning here? 88 minus 8 plus that, plus minus. And then you give me the total figure here. Cash flow from operating activities. How much do we have here? Cash flow from operating activities. How much do we have here? Cash flow from operating activities. How much do we have here? Cash flow from operating activities. How much do we have here? Rakadabra. And this is the toughest section in your cash flow. But fortunately, ladies and gentlemen, you don't have to get everything. Trust you me. You don't have to get everything right. Here we're not looking for perfection. If there is any subject that wants students who are quite imperfect, it's AFR. You'll be surprised, like here, they'll only want like any four, which are correct, any four, including this one that you've picked, any four that are, and then you get all the marks. Yeah, so Vincent is giving me a figure of 180. 180. And then now we can go to investing activities. So we have here cash flow from investing activities. Cash flow from investing activities. Please, okay. Sorry, let me just read this. So in this case here, interest, remember interest, what do we have here as interest? Interest paid is this finance cost of 12. But you see in this 12, we have a misclassification, right? These two should not, the two which is a loss on retranslating the loan. That cannot be lumped onto what here, onto finance cost. That cannot be put under, that should not be put under interest. You know, interest is what we pay as and it's ever, if it's 10% interest, it's constant. So it's 10% of maybe $1 million, right? So it's supposed to be 100,000 like that. So should we make a loss out of this loan attributable to other things? That loss cannot be put under interest. So if you look at your note number 6, we are told in note number 6 that finance cost included a 2 million on retranslation of a loan that was denominated in a foreign currency. So that 2 is out of a loss, not an interest component. So that has to be adjusted. So 12 minus 2, that gives me 10, right? And then you also asked another question up there. Why did we multiply with -1? It is a rule that for payables being a liability, whenever I get a final answer, I must always multiply it with what here? With -1. It's a rule. It's a law. It's a law. All right. Great. Sawa. So asante. So katika cash flow from investing activities, what do we have? We are able now to remember most of the things. Ladies and gentlemen, because already we have done this. For example, we can see where in this case here we acquired some machinery. Acquired, which was a grant given to us by government. Do you remember that grant? How much was it? We're given a grant by government. We received the money, we debited our bank accounts, and then the same money was now going out to buy this machinery. Are they able to remember the grant? This grant is given in note number 2. Note 2. Yeah, so grant of 3 million. Thank you very much. Remember, all our figures are in millions. And don't forget, you get something, as soon as you're trying to do like what Mwalimu is doing, I'm writing this by the side because of the size of my board. Otherwise, I would have continued. It's one statement. So machinery acquired, grant 3. So what else do we have, ladies and gentlemen? Remember, we also brought in some investment property. We have some investment property. So remember, this machinery acquired, the grant, this and the investing activity. So the machine came, money went out. So it's supposed to be in bracket. The machine came, money went out. It's a cash outflow, right? Then we have in this case investment property acquired. Is there somebody who is able to remember an IP that we acquired? There's an IP that we acquired. Ilikuwa note number what here? There is an IP, investment property that was acquired. It was not number 3. Note 3. Investment property acquired. Investment property acquired. Yeah, 14. What else in this case here are we able to see, ladies and gentlemen, that was really done here? Yes, we have another investment that we made. We bought in some associate. So investment in associate. in associates. Is there somebody who is able to remember that we bought some shares? Yeah, if you look at note number 5, 3 marks really, note 5. If you look at note 5, 3 marks. So note number 5, investment in associate, how much? It's only Vincent anaona cha anafanya. It's only Vincent anaona cha anafanya. Wengine hawaoni. Wengine hata Laura pia ameona. Laura ameona. Lakini tuko pamoja kweli? Laura pia ameona. Laura ameona. So in this case here we have yes. Now, if in this case here, of course, this we are investing, we are buying shares in associates here. So money is going out. Then of course, if we have these associates, we must receive dividends. So dividend, in this case here, dividends from associates. Dividends from associate, this is normally a little bit complex working. In an exam, personally, I will not do it in an exam, but given that we are doing it here, investment from associates, investments out of what here? Dividends out of our investments. Dividends out of our. So this is very easy. You simply track, okay, it's easy, but it can take your time. You simply track your associate account. Track your associate account. Investment in associate. Investment in associate. So investment in associate. So we have here balance brought down. So balance brought down is how much? Please look at your associates. Look at your associates. Look at your associates and the non-current assets. Look at your associates and the non-current assets. Is there somebody who is able to see some balance that was brought down there? And the non-current assets, beginning on top there, and non-current assets. Are you able to see? Are you able to see just a minute? So we are doing this for investment in our what here? In our associate. So are you able to remember that we acquired? Are you able to remember that we, no. Investment in associate brought down is 103. 103. Then we acquired new associate. At how much? At how much? We acquired new associate at how much? Yes, we acquired new associate at how much? Oh yeah. Note number 5. 14, are you sure? Associate acquired, the new associate acquired. New associates acquired. 65. Check there. Note 5. During the period, 5 million in cash was spent on investment in associates. 65. And then we were very lucky. There was a sub that in this case here became a sub changed to associate in the period. Remember, initially we had 90% of this company. This initially 90 from note 4, 90%. Now we have 40%. So of course we had done this, we sold 50%, we're left with 40. But what is this 40%? So this 40% is an associate. So in this case here, we have a subsidiary that changed to an associate. So are you able to see the value of these assets in this case here that now we are receiving as associate? Now that we are receiving as an associate, if you read note number 4, 𝐂𝐸𝐿ima Group disposed of some of its shares held in Shamba Limited. 𝐂𝐸𝐿ima held 90% of the shares in Shamba Limited before disposal and 40% of the shares after disposal, leaving it with significant influence. That's an associate. 𝐂𝐸𝐿ima Limited received cash proceeds from this sale. The profit on disposal of 3 million was correctly valued. The fair value of the interest retained, what we retained at 40%, this 40% is valued at 32 million. So 40% value of the 40% retained. Value of the 40% retained. And then remember, we received profits from associate. This will be increasing our investment. Profit from associate. How much profit from your income statement did we receive from the associates? From your income statement, you even have it somewhere there. How much profit did we receive from the associate? Yeah, no problem, Monica. You should not be sorry all the time. Kuna sorry unafungia, Monica. In life, kuna zile sorry unafungia. Ukiwa sorry sana, ukiwa too gentle, people will take advantage of you a lot as an accountant. Kuna sorry zinazosema sana. Aha. Yeah. So in this case, we received some profit from the associate. From the income statement, it's given there. I can see share of profit in the associate 21. So please, on this side, come and give me the balance carried down. Give me the balance carried down. Give me the balance carried down. So the balance carried down is how much? Balance carried down for the associate. Balance carried down for the associate. 204. So do your balancing, and the balancing figure, of course, in this case here, if they are not, it will be dividend here. Dividends paid. So is there somebody who is able to give me this figure here? Where most students are never able to remember, but I believe and pray that you guys will remember this. It is this sub change to associate, because we received a new associate out of the change. So can somebody first of all give me this total here? Somebody first of all give me this total here? 221. Thank you very much. So this is 221. This is 221. Then in this case here, how much dividend was paid by this associate? So it is 17. Like that. So remember, we are the investors. So ourselves will talk about dividends from the associate. What we received from the associate in this case here is 17. I would, ladies and gentlemen, request that you allow Mwalimu to disappear. All right. Otherwise, don't close this account yet. We still have a few more things, but we have done basically most of it, and you have this video somewhere. But tomorrow I'll have to finish the whole of this because of what here, because of laying a foundation. After that, now we start doing the others without wondering about what here, about balancing. Otherwise, thank you very much. Be blessed. Please continue studying this subject. Bye-bye. Okay, bye.